The screen is quiet. No dramatic music. No flashing charts. Just a slow zoom into a price chart that's been bleeding for weeks. Red candles. Lower highs. Another stop-loss hit. Somewhere, someone closes their laptop and leans back in their chair. Not angry. Not panicked. Just tired. This is the moment most people never talk about. Not the wins. Not the screenshots. This part, the drawdown, where confidence feels expensive and patience feels pointless. Where every trade starts to feel personal, and every decision feels like it's being judged by the market itself. At first, the plan was clear. Long-term vision. Trust the process. Stick to rules. But after the third losing streak, after the fourth time price almost worked and then didn't, something shifts. The mind starts bargaining. Maybe I should size up to recover faster. Maybe this system stopped working. Maybe I just need one good trade to reset everything. And that's the trap. Because drawdowns don't just test capital, they test identity. They whisper a dangerous question. What if this means I'm not good at this? Most people think long-term thinking is about being optimistic. About believing things will get better. It's not. Long-term thinking is about staying logical when emotions are screaming for urgency. It's about understanding that the market doesn't reward desperation, it punishes it quietly, trade by trade, decision by decision. The traders who survive drawdowns aren't the ones who avoid losses. They're the ones who refuse to let short-term pain rewrite a long-term edge. They don't react. They zoom out. They don't chase recovery. They protect consistency. They understand something most never realize until it's too late. Drawdowns are not a signal to act faster. They're a signal to think slower. And right here, in this uncomfortable, silent phase, is where long-term thinking stops being a concept. And starts becoming the difference between those who fade out quietly, and those who stay long enough to let the edge play out. Stay with this, because what most traders do next is exactly why they never recover, and why long-term thinkers do. 1. When the market goes quiet. The losing streak doesn't announce itself. It doesn't arrive with drama or chaos. It creeps in slowly, one trade that didn't follow through, another that stopped out by a few ticks, then one more that should have worked but didn't. At first, it feels normal. Losses are part of the game. Anyone who's been around long enough knows that. So the trader does what they've always done, they review, they journal, they move on. But then the chart starts to feel different. Setups still appear, but the confidence behind clicking the button isn't the same. Entries hesitate. Exits come a little earlier than planned. Every green candle feels suspicious. Every red one feels personal. This is where the drawdown really begins, not in the account, but in the mind. The market goes quiet. No big wins. No validation. Just silence between trades and questions that get louder the longer nothing works. The kind of silence that makes someone stare at a chart longer than they should, searching for answers that aren't there. Most people think drawdowns are about bad timing or bad luck. They're not. They're about friction, the friction between what the system says to do and what emotion wants to do right now. The trader remembers the plan. The risk model. The edge. All of it still makes sense on paper. But paper doesn't feel pressure. Paper doesn't watch unrealized profit turn into loss in real time. So small compromises start to slip in. A trade taken slightly early. A stop adjusted, just this once. A rule bent, not broken, at least that's how it's justified. Nothing explodes. Nothing dramatic happens. And that's what makes it dangerous. Because long before accounts blow up, discipline erodes quietly. This phase feels harmless. Manageable. Temporary. The trader still believes they're in control. But something important has already shifted, the focus has moved from execution to outcome. From process to relief. And the market notices. Drawdowns don't punish recklessness first. They punish impatience. They expose how much of someone's confidence was built on recent results instead of long-term understanding. This is the part no one posts about. No screenshots. No lessons wrapped in clean conclusions. Just a trader sitting with uncertainty, trying to decide whether this is normal variance or the beginning of the end. And what happens next depends entirely on how they think about time. Because in this moment, short-term thinking feels comforting. Long-term thinking feels unbearable. And most people choose comfort, without realizing the cost. 2. The urge to fix everything. After enough red days, silence turns into pressure. Not the loud kind. The quiet, internal kind that sits in the chest while the chart loads. The kind that makes someone feel like doing nothing is the same as falling behind. The trader starts watching price more closely now. Every tick feels important. Every pullback feels like a missed opportunity. The plan is still there, written down, unchanged, but it suddenly feels slow. Outdated. Almost naive. This shouldn't take this long. That thought shows up more often than it should. So the fixing begins. Not recklessly. Carefully. Reasonably. At least it feels that way. A slight adjustment to entries. A new filter added to avoid losses. Risk tweaked just a little to make the wins feel meaningful again. Each change makes sense on its own. That's the problem. Nothing here feels like a mistake. There's no emotional outburst. No revenge trade. Just a quiet belief that something must be optimized, because surely the market wouldn't stay like this if the system were truly solid. The trader tells themselves they're adapting. But adaptation and reaction don't look different in the moment. They only look different in hindsight. Losses keep coming, but now they feel heavier. Not because they're larger, but because they're confusing. The system is no longer pure. Results can't be trusted. Wins don't bring confidence, only relief. And relief is a dangerous reward. It trains the mind to chase the feeling, not the edge. At this point, the trader isn't fighting the market anymore. They're fighting time. Fighting the idea that progress should be faster, cleaner, more obvious. That a long-term strategy shouldn't feel this uncomfortable. But discomfort is exactly what long-term thinking demands. The market doesn't move on a schedule that respects effort. It doesn't care how long someone's been patient. It only reflects what was executed, not what was intended. So the trader watches. Adjusts. Questions. Tries again. And slowly, almost invisibly, the original edge starts to disappear beneath layers of well-meaning fixes. The strategy no longer fails because the market changed, it fails because it's no longer the same strategy. This is the moment most traders never identify. They don't realize they stopped trusting the process weeks ago. They think they're refining it. Improving it. Saving it. But the truth is simpler and harder to accept. They're trying to escape the waiting. And the market is very good at punishing people who rush what was designed to work over time. 3. When short-term pain starts writing the rules. There's a moment in every drawdown when the chart stops being information and starts being a mirror. The trader doesn't notice it at first. They just feel it. A subtle shift in how every setup is judged. Not by its quality, but by how badly a win is needed right now. A valid entry appears. Clean structure. Clear risk. In another season, this would have been taken without hesitation. But today, the hand hovers over the mouse. What if this one loses too? That question wasn't part of the system. But now it's there, quietly rewriting the rules. When short-term pain takes over, logic doesn't disappear. It gets rearranged. Risk is still calculated, but emotionally. Stops are still placed, but with hope attached. Targets are still defined, but rarely reached. Every decision becomes reactive, shaped by the last few trades instead of the next 100. The trader starts interpreting the market through recent memory. A pullback looks dangerous because the last pullback failed. A breakout feels fake because the last one trapped them. Patterns don't change, perception does. This is how long-term edges get suffocated. They aren't destroyed by one bad decision. They're eroded by a series of reasonable ones made under pressure. Each choice feels justified in isolation. Together, they form a completely different strategy. Now wins feel small and losses feel loud. Not because the numbers changed, but because the meaning attached to them did. A green trade doesn't prove anything anymore. A red one feels like evidence. Evidence that something is wrong. Evidence that maybe this isn't working. Evidence that time is being wasted. And that's when the rules start bending further. Entries become selective in the wrong way. Trades are skipped not because they're bad, but because confidence is low. Risk is reduced, then increased, then reduced again, not as a plan, but as a reaction. The trader is no longer trading an edge. They're trading a mood. What makes this phase dangerous is how invisible it is. From the outside, nothing looks broken. The account still breathes. Losses aren't catastrophic. But internally, trust has collapsed. Trust in statistics. Trust in patience. Trust that the future matters more than the last trade. Short-term pain is loud. It demands attention. It wants action. And if it isn't managed, it slowly replaces discipline with urgency. By the time most traders realize what's happening, they're no longer asking, "Is this a good trade?" They're asking, "Can I handle another loss?" And once that question enters the process, long-term thinking is already fighting from behind. 4. The illusion of control. Drawdowns have a strange effect on confidence. They don't take it away all at once. They reshape it. The trader still believes skill matters, they just start believing it should matter more. That if they watch closely enough, react fast enough, adjust precisely enough, the market will eventually cooperate. This is where the illusion of control takes over. The charts are opened earlier. Closed later. Time frames multiply. What used to be a clean process turns into a constant scan for confirmation. Every candle is inspected. Every wick is analyzed for meaning. The trader tells themselves they're being diligent. But diligence has quietly turned into surveillance. Long-term thinking requires space to let probability unfold, space to accept randomness, space to be wrong without interference. And drawdowns make that space feel unbearable. So control becomes the substitute. Stops are tightened to avoid unnecessary losses. Targets are pulled closer to lock something in. Trades are managed aggressively, not because the plan says so, but because holding feels risky. And the market, as always, does what it does best. Price moves just enough to stop them out, then continues in the original direction. Again. And again. Each time reinforcing the belief that something needs to be adjusted. The trader feels active, involved, responsible. Losses feel earned instead of random. And that feels better, temporarily. But this kind of control is expensive. It trades long-term expectancy for short-term comfort. It replaces trust in structure with trust in reflex. And reflexes don't age well in probabilistic environments. What's lost here isn't money first. It's distance. Distance from the last trade. Distance from emotional noise. Distance from the need to be right now. The trader starts believing survival comes from constant engagement. That stepping back is dangerous. That patience equals passivity. In reality, the opposite is true. The more they try to control every outcome, the more exposed they become to the randomness they're trying to escape. Because markets don't reward attention, they reward alignment with time. This phase feels productive. Charts are busy. Notes are detailed. Adjustments are logical. But beneath it all is a quiet fear. If I stop managing this, I'll lose control. What the trader doesn't realize yet is that control was never the edge. The edge was time. And the longer it takes to remember that, the deeper the drawdown feels, even if the numbers haven't changed much at all. 5. The moment time becomes the enemy. There comes a point when the drawdown stops feeling like a phase and starts feeling like a verdict. Not spoken. Not confirmed. Just implied. The trader looks back at the calendar more than the chart now. Weeks have passed. Maybe months. The account isn't destroyed, but it isn't growing either. And somehow, that feels worse. Flat feels like failure. This is where time quietly becomes the enemy. Every day without progress feels like proof that something is wrong. Not with the market, with the approach. With the idea of waiting. with the belief that patience will eventually be rewarded. The trader starts measuring effort in hours instead of executions. Screen time replaces strategy. Being busy feels productive, even when nothing improves. There's a pressure here that's hard to explain to anyone who hasn't lived it. A sense that life is moving forward while results are standing still. That opportunities are passing by while capital stays locked in uncertainty. So the temptation grows. Not to gamble. Not to blow up. But to speed things up. Take more trades. Shorten the time frame. Look for quicker feedback. Something, anything, that creates motion. Because motion feels like control. And stillness feels like decay. This is where long-term thinking becomes incredibly uncomfortable. It asks the trader to accept that time invested does not guarantee immediate return. That consistency often looks invisible before it looks impressive. That edges don't announce when they're about to pay off. The mind resists this hard. It wants reassurance. It wants confirmation. It wants to know this isn't all a waste. So it starts rewriting the story. Maybe this works, just not for me. Maybe the market has changed permanently. Maybe waiting is just another excuse for not adapting. These thoughts feel logical, rational, even mature. But beneath them is a simpler fear. What if nothing happens? Long-term thinking doesn't fight that fear by offering certainty. It offers something harder, acceptance. Acceptance that outcomes are delayed. That periods of stagnation are part of the cost. That time isn't something to beat, it's something to work with. Most traders quit here. Not dramatically. Quietly. They pivot. They restart. They chase a new idea that promises faster results. And they never realize how close they were to the part where time stops taking and starts giving. Because the market doesn't test patience once. It tests it until it breaks, or until it becomes unshakable. 6. When long-term thinking finally clicks. It doesn't happen during a win. There's no breakout trade that suddenly fixes everything. No massive green day that erases the weeks of doubt. The shift happens quietly, almost disappointingly. The trader notices they're less reactive. A loss comes in and nothing follows. No urge to change anything. No need to explain it away. It's logged, reviewed, and left alone. At first, this feels wrong. Like something is missing. For so long, action followed emotion. Now there's space. And in that space, something uncomfortable but powerful appears: clarity. Long-term thinking finally clicks when the trader stops asking the market to make them feel better. They stop using trades to repair confidence. Stop expecting the next setup to redeem the last one. Stop treating every outcome as a verdict on skill. Instead, they start seeing trades as data again. Just entries. Just exits. Just probability playing out over time. The chart hasn't changed. The system hasn't changed. But the relationship to both has. There's a strange calm in this phase. Not excitement. Not optimism. Just steadiness. The kind that doesn't need confirmation. The trader executes the same way on a good day and a bad one. Risk is consistent. Rules are followed without internal debate. Wins feel nice, but they don't raise expectations. Losses feel neutral, not threatening. This is where most people misunderstand long-term thinking. They assume it's about believing things will work out eventually. It's not. It's about accepting that no single trade matters enough to react to. Time becomes an ally again. Instead of watching every candle, the trader checks in less often. Instead of managing trades emotionally, they let structure do the work. Instead of chasing activity, they protect consistency. And slowly, so slowly it almost feels imaginary, the drawdown stops deepening. Not because of a breakthrough trade. Because of a breakthrough in behavior. The account stabilizes. Then it breathes. Then it inches forward. Nothing dramatic. Nothing screenshot-worthy. But something important has returned. Trust. Not blind trust. Earned trust. Built on repetition, not hope. On discipline, not urgency. This is the moment long-term thinking stops being a concept and becomes a habit. And habits don't care how the last trade went. They just show up and let time do what it was always meant to do. 7. The part no one sees. By the time things start working again, no one is watching. There's no announcement. No sudden surge of confidence. Just a quiet realization that the trader hasn't checked their P&L in days. That trades are being placed and managed without emotion tagging along for the ride. The recovery doesn't feel like revenge. It feels ordinary. And that's the point. Long-term thinking doesn't end with a dramatic turnaround. It ends with boredom. With repetition. With doing the same unremarkable things over and over, long after the urge to quit has faded. This is the phase that never makes it into highlight reels. The trader doesn't talk about the weeks where nothing happened. The sessions where discipline mattered more than insight. The days where the best decision was to do less, not more. But this is where the edge finally breathes. Because long-term thinking was never about enduring pain endlessly. It was about surviving long enough for probability to matter again. About not interfering when the system needed time more than intelligence. From the outside, it looks simple. From the inside, it took everything. It took letting go of urgency. Letting go of ego. Letting go of the need to feel productive every day. It took accepting that consistency is quiet and growth is delayed. Most traders never reach this point because they mistake intensity for progress. They think effort should be rewarded immediately. They think patience should feel good. It doesn't. Patience feels like standing still while everyone else seems to be moving. It feels like trusting math when emotions are screaming for proof. It feels like choosing boredom over excitement, discipline over relief. But this is where longevity is built. Not in the wins, but in the refusal to self-destruct during the waiting. Long-term thinking doesn't protect you from drawdowns. It teaches you how to exist inside them without losing yourself. Without rewriting the rules. Without turning a temporary phase into a permanent exit. And once that lesson is learned, something subtle but permanent changes. The market stops feeling like an opponent. Time stops feeling like a threat. And trading stops being about getting back to something. It becomes about staying long enough for the edge to keep working, quietly, steadily, exactly as it was always designed to do. If you've made it this far, that already says something about you. Most people click away when the conversation gets uncomfortable. When it stops promising quick fixes and starts talking about patience, restraint, and time. But this is where the real work lives, not in entries or indicators, but in how you think when nothing seems to be working. Drawdowns don't mean you're broken. They don't mean you failed. More often than not, they're just the market asking one question. Can you stay consistent longer than your emotions can stay loud? Long-term thinking isn't flashy. It doesn't feel powerful in the moment. It feels quiet, repetitive, even boring. But it's the reason some traders are still here years later, while others disappear without ever knowing how close they were. If this video made you reflect, even a little, don't keep that to yourself. Drop a comment. Say where you are in your journey. Say what part hit you the hardest. Someone reading it might be in the exact phase you've already survived. If you found value here, help this reach the people who need it most. Like it. Share it with a trader who's going through a rough stretch and questioning everything. Sometimes one perspective is enough to keep someone from quitting too early. And if you want more content like this, real conversations about trading, mindset, and staying in the game when it's not glamorous, subscribe. Not for hype. Not for signals. But for clarity when the noise gets loud. Because the market doesn't reward those who rush. It rewards those who last. And if you're still here, watching until the end, you're already doing something right.